Hey traders, David Frost, My Strategic Forecast. You're here for another episode of Common Sense Market Analysis. Today is Thursday, October 24, 2024. We're looking at a daily chart of the SPY or Spider, which is the proxy for the S&P 500. What do we have on that docket today? We had a rather narrow ranging day. It was a rather quiet day, a couple of moves here and there. We'll get to that in a moment. All she did was come back to retest the 20-period moving average. However, as the market tests and retests the same moving average, it diminishes the importance of said moving average. When a market comes from afar and hits a moving average and hasn't visited in quite a while, that has a different meaning than a market that's trading in and around a specific moving average. Those two things are treated very differently. Might want to write that down, put it on a sticky note. Little housekeeping item. The live room will be open tomorrow on Friday. Jordan will moderate the room. He'll have the numbers and all the necessary stuff that I'm able to give him before I've got to leave for my commitment. I am leaving early. I'm not sure what kind of stocks on the move will be on the board. Whatever happens after the close today, we'll try and pick up on it first thing in the morning, and I'll try and get the numbers up there. Speaking of the numbers, we're talking this table, some stuff. Most of the top stuff, the first 7 or 8 will stay the same. We'll do it based on demand. But for those of you interested or already do trade in these markets, it may behoove you to check out these numbers and see if it's something that you want to have each and every day. This is part of the membership for Inside the Numbers and part of the membership for the live room members. Now, back to the S&P. I want to show you something really slick. Remember from yesterday, the 574.71, that was this high here. We call that the most recent breakout area from a daily chart perspective. We had the discussion last night along with the 20-period moving average or home base. They spiked it, they bounced back, all that stuff. So remember that number. Now watch this. Check this trend line out. You got point A, then you have point B. They connect, makes a trend line, and when you go down to the intraday chart from yesterday, you can see what happened. They came to a number, they came to a trend line, and they also came to ES 5800. This is yesterday's low in the ES, and it's 5801 on the button. We talked about this in the live room. When you have things like that that stack up, this is called a full stack. This is the type of trade where you have 3 or 4 things that are stacking up together, making it a full stack. This is the trade you take with 3 hands. Now, shame on me. I wasn't paying attention yesterday. I didn't have or zero in on the trend line. I wasn't paying attention when this happened in the afternoon session. It was at around 2:15 in the afternoon. I wasn't even around the computer. However, have I been around the computer and I was tuned in to all these things and that full stack, that would have been a take it with 3 hands opportunity. This one's going to work about 9.3 out of 10 times. Just look at that, the big picture. You got a hell of a trend line. They tested it, happened to be in the same location yesterday as the most recent breakout area. And by the way, it was a spike through home base, which they hadn't visited in a while. And just a few days earlier, they were getting a little bit far from home base. Remember that one? This one was a see it after the fact, kick yourself in the ass, you dumb shit type of trade or non-taking trade setup situation. But what we can do is learn from this for the future. And when we're watching another market or this market and we have a similar type of setup, you'll remember this conversation and you know this one has a high percentage of working out in your favor. Therefore, you take the trade. We talked in the live room this morning about how you take the trade, how I would have taken it had I seen it yesterday afternoon, all that stuff. Would have been an option trade, what would have been the expiration, the strike price, all that stuff. Woulda, coulda, shoulda. We're moving on. We're back to Inside the Numbers. We're going to check out the commentary today. Here's a blurb on Tesla early this morning. They were getting a nice rally. They actually rallied them right into the end of the day for the most part. They had a tremendous rally today, up over 20% in Tesla. What do we have today? Well, the early look was 581 as the pivot. Let's go see what that looked like. There's a 5-minute chart. Right of the vertical is today's activity, and as you can see, they never got to 581 today. The pre-market was up there earlier, and you could see here in the pre-market activity, that was in fact our early pivot, but even by the opening bell, they never sniffed that area again. So what do we have? How do we make an adjustment? Hold your horses. Good question. Well, if she can't sustain price above 581, she's susceptible to fall back toward 579.60, give or take. And there you have it. Guess what that became later? That became the pivot. In fact, that became the bear pivot. Staying below, she was bearish. Above, she's bullish to rally. And you can see, never really got above for more than a few minutes at a time. That was it. This became our bear pivot. By the way, I just want to go back to this, that are from a bigger picture perspective. Some of the trades that we take from these numbers, meaning there may be higher numbers that are tradable in real time as the market's closer to the opening bell. But these are big, important numbers. We're looking at 577, support number 1. So if you were just a trader with patience today and you said, well, look, I'll just wait for them to give me 577. I don't want the gap. They played games with the gap. They come up short. The gap's over here. They come up short. They bounce away. Then they trade through it. That's a sucker's game. I talk about it all the time in the live room. The gap is just a gap. If I have a number below a gap, we like to spike the gap and rip it back up in the other direction at my number. In this case, it was 577. And if you just sat around and waited for 577, bought 577, and then exited at the number above, found where? Yeah, no heat, trading. Think about that one for a moment. Pause the video, read the notes, go back to the chart, and double check the work. 934 right now, 579.60 is important. Above, the door's open to go higher to 581, staying below, and the door's open for the gap first, down just at a spike below 578. This is the way the day starts. Pause the video, chart and double. Pause the video, read the notes, go back to the chart. Back place on a spike of the gap. Remember what I said before, 570, and they got there about 11:45, and they stayed there for about, what's going on over in Camp IWM? No material change today other than that happened. They're beginning to go sideways. They do one of these deals, and the next day they do one of these deals, like on Monday or something like that. Then they're putting in a bearish, wedgish formation of that when and if that does develop. Right now, they're contained around the 20-period moving average. Not a lot of further development from yesterday. What about the folks down at the transportation department? They were down $10 on the day. That's a rounding error. The IWM was up 0.2%. The spiders of the S&P was up 0.2%. So everything was kind of around the flat line-ish. We're not going to read too much into that right now. Again, they're also contained in between the 20 and the 50-period moving average on the daily chart. Not a lot of type of situation. Not the same as some other charts, but this is resident in the transport charts. We treat each chart independent of one another. Markets are not correlated. They are all the same, meaning they all trade in the same direction. All the equity markets are going up or all the equity markets are going down, but they don't always have to do the same thing each and every day. And there are divergences on charts, and some charts are doing different things at points in time than other charts. And therefore, we can note that we are in an on-time type of situation for the transport chart, which looks different than some of the others. Of note, puzzle piece, and we'll put it on the table. For example, looks totally different than the Q people. They're just eating time off the clock above the 20-period moving average, and also, by the way, above all the moving averages, eating time off the clock. The trend is your friend. There's nothing wrong with the Qs. They are in an uptrend and no reason to be alarmed until that changes. We are the umpire calling balls and strikes We assess and analyze the market that's in front of us today, not the one we may like to believe it is or should be based on what the wall of worry says. How do you like dem apples? Any material change in the financial space today? Not really. They are putting in somewhat of a bearish kind of flaggish situation. However, what they're also doing is, while in an uptrend, eating time off the clock, allowing the 20-period moving average to creep up to price. Price came down a little bit toward the 20-period moving average, and this also is normal garden variety market behavior. As an umpire calling balls and strikes, we note one thing. We note they're in an uptrend. We note another thing, that they could be in a micro or short-term bearish flaggish situation, but also maybe just in an effort to come down and run a test of the 20-period moving average. And if they were to spike through the 20-period moving average, we do have 45.90 just below. That also represents the area of the most recent breakout area on the daily chart. Might want to write this stuff down, put it on a sticky note. Again, we're talking apples. Do you like dem apples? What about Smashmouth, the Philadelphia semiconductor space, SMH, aka Smashmouth? Again, this chart looks different than the rest. My issue is the $14 down day, the flare up in the air. This one is the warning signal. They are putting in a bearish, wedgish, sloppy-ish kind of thing, riding the 20-period moving average, have yet to be able to get up to run a test near the high of the breakdown candle, but staying above the 20-period moving average keeps them in the they still have a chance camp. Drop below, stay below the 20 and the 100, which is the purple line, and you're starting to leak, and this is starting to play out to the downside, down to 232, 231, in that neck of the woods, as they say in the trading parlance. If they're doing that, other markets are falling as well. If they're riding the wave to the top of, or running a test of the top of, or in the top neighborhood of the breakdown candle where you see the arrow, then other markets are likely rallying as well. If I told you how much I appreciate each and every one of you, without you, these videos, they're not possible. That is true and accurate information. We're pulling the ripcord here today. I'm David Frost, My Strategic Forecast. Thanks again for tuning in to another episode of Common Sense Market Analysis.